So in the world of insurance, what is net amount at risk? Net amount at risk is sort of the magic by which these insurance policies work. Here's the idea. Our example that we've used so far in our insurance video series is a 25-year-old male in good health, non-smoking, with 2 living parents. All right, and this person gets a really cheap rate on what they pay in premium because their chance of dying is relatively low compared to other 25-year-olds who maybe aren't as in good health or that smoke or don't have living parents. And so we're going to say this person gets really low insurance cost. And the insurance charges we've modeled out here, around $100 for this person. And their actual chance of dying is pretty slim. Now, the beauty of a permanent insurance product is pretty straightforward. Over time, the cash value will grow, albeit a credited rate, a variable rate, some magic index formula rate, but over time, 5 years, 10 years, 20 years, that cash value starts to grow. And 20, 25 years in is sort of when the growth gets to be exponential and compounding growth and time value of money. And we wind up in a world where you're 20, 25 years in these policies, the cash value becomes significant. And if you haven't taken it, if you haven't touched it, if you've kept paying your premiums, you've got this asset and it's going to keep compounding every year, okay? As it compounds, the amount of insurance I actually have to write for you decreases over time. So let's kind of visit. Most universal life insurance is what we call type A or type 1, depends on the company. But your net amount at risk decreases over time. So let's just take this quick example. 20 years in, we're 20 years in, this person's been paying 20 years of premiums, and we have $100,000 in the cash value. Well, with type 1 insurance now, the death benefit is still $500,000, right? That's what we wrote. So you've got a $500,000 death benefit. You've got a $100,000 cash value. And what that means is the insurance company is now only insuring the difference. So the net amount at risk dropped over time. Well, why is that good for everybody? That's good for everybody because as you get older, your chance of dying increases every year, right? A room of 1,000 50-year-olds, fewer people come out of that room than a room of 1,000 20-year-olds, okay? So the idea is that if we can lower the amount at risk every year, then we're not going to have to charge you the same amount on insurance every year. And what winds up happening if you hold this thing 30 or 40 years in is you wind up with very, very little net amount at risk, and the insurance cost is very, very low, and that's where these cash values really start taking off. So the less net amount at risk, the lower the insurance cost, the more the cash value can perform. All right, and all that's built into the assumptions and pricing, but it does come into play, and I think that's where you kind of have this idea. Oh, these policies aren't good. These policies aren't good. Oh, these policies are good if you hold them long enough. And I think that's where my addition to your knowledge. Hold it long enough, it starts to really work. But if you want it after 3, 5, or 10 years, it's really not a great place to put your money because it's not built for that. There's a second type of universal life policy called type B. Type B, the net amount of risk stays the same. So when you die, you get the death benefit plus the cash value. That is more expensive. It has a higher insurance cost because the insurance company is insuring the whole net amount at risk when you're 20, when you're 50, and when you're 90. So it's going to be really expensive over time. All right, so type B insurance, a little more death benefit, costs more. Type A insurance, better cash value, bang for your buck. So that's kind of it as far as universal life goes. I think it's worth noting that universal life, there's not much that's locked down, okay? There's no guarantee that the insurance charges stay the same. If for some reason we have another pandemic and mortality rates go up, you better bet insurance companies will raise mortality rates. That insurance piece will be greater. There's no guarantee on the expense load. If the cost of operations for the company go up, they might charge a higher expense load. Okay, universal life doesn't have much locked down. So your premium is locked in, the death benefit's locked in, everything else, Godspeed, right? So that's where universal life, you understand all these pieces, the pieces can change, but the crediting rate, you locked in. As long as you make your premiums, you get the death benefit most of the time, and that's gonna be how these things work. So UL, VUL, IUL, hold it a long time and you'll see some benefits. It's again, not an investment. It's not a retirement account. It's a way of having insurance that's net amount at risk decreases over time. And that compounding does work out pretty well, especially when that rate is maybe greater than treasuries or other types of investment options that are fixed. But this is how these UL policies work. I hope you have a better understanding of it now.